Health insurance subsidy premium tax credit reconciliation for 2022. How does it all work? Hello, I'm Kevin Canals with InsureMeKevin.com. And in 2021, the American Rescue Plan changed the subsidy curve for the subsidies for health insurance that people received when they enroll in a health plan through the marketplace, such as Covered California. And some of the changes in 2021 do not carry over into 2022 because there was no pandemic unemployment benefits and things of that nature. So it's slightly simpler for 2022, but still the process is complicated. But I just wanted to take you through how it's all kind of calculated behind the scenes, because most people will have a professional tax preparer do their taxes, or they'll be using a computer program. So first, let's start with the subsidy curve that was enacted in 2021. And if you'll notice, it goes down to 150% of the federal poverty line. So this curve is based on the federal poverty level and the household income. If the household income for the household size is below 150% of the federal poverty level, then the calculation states that for the second lowest cost silver plan, the family should pay zero. That means the subsidy would be equal to the second lowest cost silver plan. Now, with that subsidy, of course, you can apply that to any metal tier or second or other silver plan. It does not have to be the second lowest cost silver plan. It's just that that is the plan cost that the whole Affordable Care Act keys off of. Then from 150% of the federal poverty level up to 400%, you'll see that consumer responsibility increases to 8.5%. And for households that have an income over 400%, and this was one of the big changes in 2021, there is no longer a cliff or a cap or a threshold. You can continue to receive a subsidy if you make 500 or 600% of the federal poverty level, as long as the cost, the annual cost of the second lowest cost silver plan is greater than 8.5% of your household income. The subsidy is just to bring it down to 8.5% of the household income. Now, when we talk about income, that can be complicated as well. And all of this information I am pulling from Form 8962 and the instructions from Form 8962 published by the IRS for tax year 2022. And they have in those instructions line 2A, which is the calculation of your income. And what I have done is I've put in the actual descriptors for the different lines because they want you to go to different forms. But essentially, it is your adjusted gross income from line 11 plus tax-exempt interest, foreign earned income, and Social Security benefits. That equals your modified adjusted gross income. And just not for the primary taxpayer and the spouse, but any tax dependents who may have to file a federal income tax return because they owe income tax. That is added in to the modified adjusted gross income. So let's look at a family. I have a family of 3, and they had an estimated modified adjusted gross income when they entered Covered California of $77,413, essentially. So we take the federal poverty level for 2022, and we divide that into that estimated income, and it comes out to 353%. So we take the line and we go up, we intersect the curve and go on over, and it says their consumer responsibility is 7.33% of their household income. That means that they should pay no more than 7.33% of their household income for the second lowest cost silver plan. The subsidy makes up the difference if that second lowest cost silver plan is greater than 7.33% of their household income. So we have the income, and at the end of the year, people are receiving a 1095-A tax document from their exchange. Now, this particular family, they entered Covered California. They had the same health plan the whole year, and they did not make any adjustments to their income. And that's where things start to become complicated for some families, because if they move or someone leaves the household, or there's a change of income, that will change those numbers, and it's a little bit more calculation. But you can see on this 1095-A, their monthly enrollment premiums were the same, as well as the second lowest cost silver plan, column B, and most importantly, that advance payment of tax credit was the same, and that totaled $16,808.63. So on Form 8962, that's where you reconcile your actual final modified adjusted gross income for the year with technically kind of what you estimated, because that's what the subsidies you received. And I'm just assuming that, that the income for this particular family was pretty close to their final modified adjusted gross income. And Form 8962, Part 1, it goes through the income and the household. It determines that their household income was 353% of the federal poverty level, and then they call it an applicable figure of 0.733 or 0.0733, which equals 7.33%. And line 8A is very interesting, because that's the annual contribution that they should be making towards their health insurance as a percentage of their household income. Then Part 2 of Form 8962, that's where you fill in all of the columns with the data from 1095-A. The annual premiums there in column A, the second lowest cost silver plan, the annual amount, the annual contribution that was calculated from Part 1 of $5,674, and the maximum premium assistance they are allowed under those, the final modified adjusted gross income, and finally what they received. Now, column E there, that is kind of a limiter, because it's the annual premium tax credit smaller of A or D. Now, line A, or column A, 11A, is what the household's family health insurance premiums were. But some people are in a bronze plan that may be considerably lower, and it may be lower than the actual subsidy they're eligible for. And you cannot receive a premium tax credit subsidy greater than the cost of the health plan. So if their column 11A number was $11,000 that they paid in premiums, that would have been the maximum premium tax credit they could have received. But in this case, they had actually selected a plan that was slightly higher than the second lowest cost silver plan, hence the subsidy. And they are entitled to an advanced premium tax credit of $16,832. Now, also within Part 2, but I've broken it up into another section, is where you put the total premium tax credit the family was eligible for on line 24, and then on line 25, what the family actually received as listed on the 1095-A, which was $16,809. Well, the family is eligible for an additional $23 in premium tax credit. But That is when the estimated income is super close to the final modified adjusted gross income, and usually that's not the way it works for most families. There's usually a difference. It's either much lower or much higher. So in a situation where the modified adjusted gross income was much higher, let's go through and look at part 2 and 3. And let's say line 24, the premium tax credit they were actually eligible for based on a much higher modified adjusted gross income was only $10,000. But they received $16,809. And some people will say, well, how could that have happened? Well, sometimes people get 1099 dividend and miscellaneous income at the end of the year, and sometimes they have big capital gains that they were not anticipating. And if they learn about that after the year is closed, or they have a big income increase in November or December, they really don't have time to adjust their income lower to reduce the subsidies they're receiving. So they have to take the hit when they do their taxes. In this particular instance, they received $6,809 in excess premium tax credit. Now, this family was fortunate in that their modified adjusted gross income was under 400% of the federal poverty level. Because of that, they're subject to a repayment limitation that is published in the instructions for Form 8962. And that repayment limitation for 2022 is $2,800. So they do not have to repay the full $6,809. They are limited to $2,800. And that changes, it seems to change every year. If the family income had been over 400% of the federal poverty level, then they would have to repay all $6,809. The instructions for Form 8962 in many tax documents are interesting. They change slightly from year to year as some of the rules and laws change. And there was a couple things that for some reason I either overlooked or were new. And they are questions that have been posed to me, and I thought I would just run through them, such as if someone leaves a job and they're offered COBRA insurance that may be what we consider affordable, under like 9.5%. Can they just go into COBRA and disregard that? And that was kind of a gray area for me and for some other people. But in the instructions for Form 8962, it says also, if you leave your employment and are offered post-employment coverage such as COBRA or retiree coverage, you are not eligible for that post-employment coverage unless you actually enroll in the coverage. So just because it's been offered doesn't mean you're eligible until you enroll in it. Also, Medicaid, Medi-Cal in California, and CHIP, and what happens if when you do your your taxes and whatnot, you find out that technically you were eligible for Medi-Cal, and the instructions put in there, if the marketplace made a determination that you or a family member was ineligible for Medicaid or CHIP, Medi-Cal, and was eligible for the advanced premium tax credits, when the individual enrolls in a qualified health plan, the individual is treated as not eligible for Medicaid or CHIP for the purposes of the premium tax credit for the duration of the period of coverage under the qualified health plan, generally for the rest of the year, even if your actual 2022 income suggests that the individual may have been eligible for Medicaid or CHIP, Medi-Cal in California. So just because your income comes in below that level, 138% of the federal poverty level here in California, but if Covered California or another exchange determined you were eligible for the subsidies, you're good. They're not going to claw back the subsidies. And also, they also highlight that if the household income is below 100% of the federal poverty line, which would make you ineligible for the subsidies, you could still receive them Again, if the marketplace had determined that you were eligible at the time you applied and you estimated income above 100% and the marketplace verified your income, you're good to go for the year until you make a change. So there are a lot of different iterations with the reconciliation of the premium tax credit, and this is just kind of a high-level overview of how everything works. So if you have any questions or comments, you can leave them down below. I'll research and try and give you an answer. I am not giving tax advice. I am just reading from the instructions and trying to put them into usable terms. So for InsureMeKevin.com, I am Kevin Canals.